world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here.
Hello and welcome to Rebank. I'm your host, Will Beeson. Today, Rebank co-host Aman Ghei is joined by Seb Wallace, an investor at TriplePoint, an early-stage UK venture capital firm that has invested in companies including LendInvest, Kudos, CountingUp, and many more. In this conversation, Aman and Seb discuss strategies for remote seed investing, the skew they're observing in terms of how venture capital money is flowing, startup opportunities Seb sees in insurance and capital markets, and more. To subscribe to the Rebank newsletter, including insights, essays, and written transcripts of all new episodes, please visit bankingthefuture.com. Thank you very much for joining us today. Please welcome Seb Wallace and Aman Ghei.
Hey Seb, welcome to Rebank.
Thanks so much for having me. Awesome to be on.
It's great to have you here. And maybe to start off with, I wanted you to give the audience a little bit of a background on TriplePoint, because as one of, I guess, the most active seed investors in fintech, you guys have a pretty unique structure. So maybe to start off with, do you want to give everybody on the line a little bit of a background on TriplePoint?
Yeah, absolutely. Yeah. So TriplePoint's been around for just over 15 years now. So we've been around quite a long time in the UK scene. And actually, our early stage investing began predominantly with debt investing, which obviously therefore meant that fintechs were our bread and butter. And we backed LendInvest, which were then Montello, with their first debt, Capital on Tap, Payment Sense, Contis Group, as they were called then, and several others. And so fintechs have always been something that we've been very interested in and been very close to as the kind of ecosystems develop, particularly over the last 15, 20 years in the UK, and London in particular. And so it's something that we feel that we know. And then a few years ago, off the back of the debt investing, we decided to begin equity investing at the seed stage, because often that's where we're getting involved with debt, normally receivables-based debt. So we have quite a unique structure because we're an early stage seed opportunistic Series A investor, but we also have a debt offering, which is very helpful, and there's potential synergies for early stage fintechs looking to grow.
That's really interesting, right? Because there are a lot of early stage fintech companies that are not able to get access to debt for a variety of purposes. You mentioned LendInvest, but I'm assuming that's lending, and then having a partner like you come with the equity component as well as the debt component to scale their businesses, I guess, a pretty important thing.
Normally the model, the way it works, is that you want equity in order to grow the operational side of the business, your employees, your marketing, sales, what you consider to be the tech side. But then your product, because you're a fintech, you have a significant portion of lending, or if not lending, then there's some sort of capital backing. It might be the case that you have a long-term debt facility on electric cars now, and you offer a service, basically an electric car service now, as you see businesses like EV Easy who are doing exactly that. And what's so fascinating about that is that normally you have to go to one investor to go get the equity. And then you have to go to another set of investors, normally actually a consortium at that very early stage of angels. And you have a consortium that will provide the debt. And then you build up your underwriting experience within your product. And then that allows you to then go on and eventually you go get bank debt. And what we're able to do is we're able to, particularly in cases where the business model is receivables based, like for example, LendInvest, we're able to lend off those receivables, and particularly B2B. And that's kind of our bread and butter on the debt side. And then on the equity, it is, as you'd expect, seed and Series A stage venture capital, and we view it through that lens. But what we're able to allow businesses to do is effectively power their product, which is debt, easily through one provider. And so one business recently that we've been helping very close to, SteadyPay, for example. These guys are trying to effectively pay smooth. They're fundamentally got a debt layer to them. And so we're able to do that. And not many other investors in the London fintech scene are able to do that.
Super interesting. Talking about SteadyPay, I guess the broader topic, you guys are one of the most active seed stage investors in UK fintech. What is exciting you right now in the space?
Really interesting question. I mean, so me and my colleague Daniel, we do a lot of the investing at Triple Point, and one area that really stands out that I think if you ask anybody, they will say it's really interesting. Open banking is fascinating for a whole host of reasons, and actually. Recently, blockchain has come back on the radar. And I say recently, and you can hear that in my voice, because I think everybody knows 2017, cryptocurrencies were all the rage, and then it kind of all went pop, the hype died, and then blockchain became a bad word in venture capital. But actually, I think that we're getting to a stage now where the applications of blockchain are shifting and it's maturing, and we're starting to see some real opportunities there, particularly in fintech, where it was always destined, I think, to be a fintech opportunity. And so, I think those two areas in particular are just hugely interesting, and hugely interesting not just globally, but in London, where obviously we have such developed financial services industry, and also, to be honest, world leading in a lot of cases legislation, which is often needed for things, particularly like open banking. And so those areas I'd say I'm really, really interested in at the moment.
I'd love to dive deeper into those two areas in a bit. But I guess before we go in there, Seb, on Triple Point, like what kind of size of a check are you writing today? And like what's your sweet spot in terms of, looking at a fintech deal and saying, hey, this is something we want to invest in?
Yeah, so we can invest anything from 100,000 sort of first money in, sort of in a friends and family or an angel round, all the way up to £1 million. Our sweet spot's around 500,000, 600,000, although we really can flex depending on the opportunity. So we're normally leading pre-seed or seed rounds, or we're participating in Series A's, either as a follow-on or as a first time investment. And we've actually recently partnered with the London Evening Standard for a campaign which you may have seen, which is the Kickstart Fund, and through that we are effectively providing pre-seed funding to businesses, tickets sort of up to £150,000, and being London and people being in lockdown, there's lots of different opportunities that we see through that, and that's how we're able to do the sort of pre-seed investment.
Interesting. And have you seen anything fundamentally change in the early stage market? I know a lot of people have been talking about, we're still doing deals. I think the reality is you're seeing a lot of money go into some of the later stage deals. So the value of the deals still looks nice and good, but the number of deals has come down post kind of pandemic. How are you seeing it on the seed side, particularly where like entrepreneurs and meeting them is so important in this day and age?
Yeah, and also, it's a really interesting question you asked, Alan, because the seed stage is the future A, B, C stage, right? So what's happening now is kind of the beginning of what will unfold over the next few years at the later stages. And so when COVID hit in March, obviously no one really knew what to think, and everyone was saying, deal volumes will drop, and they have, and the stats are now out, they have dropped. But fortunately, in the seed stage in particular, there's less in the company's operations. It's that the companies are newer, less mature, and that means that due diligence is typically desktop. And then in terms of meeting founders, obviously that is the number one thing everyone looks for at seed stage, where that is the one thing you can really anchor off to gain conviction. And I think probably fundamentally, like everybody at the later stage, Zoom has become absolute bread and butter, or video conferencing generally. If things are advancing, me or another colleague can always meet up with the founder once, twice, just to kind of get a sense and meet face to face. But sometimes the deals are happening very quickly, and I actually think at the seed stage, people have found their rhythm again, and investments are still happening into good businesses. I think you're right though that fewer investments will happen. I think that perhaps there's renewed emphasis on quality. There always was an emphasis on quality, but just a renewed emphasis. But we've certainly seen good competition. Valuations haven't significantly changed. They have decreased a little bit in some cases, depending on the area, sector, stage. And by stage, I mean, are they raising a seed round off a little bit of revenue, or raising a seed round off a decent amount of revenue, which is, both come to seed stage and both raise both types of companies. But yeah, overall, I'd say it's actually a much more positive picture than I think I would have painted 3 months ago.
Super interesting, Seb.
Yeah.
Well, I'd love to dive into kind of some of the industries we spoke about, and let's get started with maybe something that is going to be controversial, which is blockchain.
Yeah.
And I think, as you rightly mentioned, there was, particularly around kind of 2018, in some areas, trade finance, remittance in particular, this, let's call it hype for now, around blockchain, right? So I'm curious to understand kind of where do you see this vertical going as an early stage investor, right? And also kind of keep in mind that maybe later stage investors are looking at it, from my view at least, and saying, hey, when are we kind of really going to see some applications built on top of this that have true scale and have achieved kind of certain amount of revenue? And at the same time, I guess we shouldn't really be talking about things in terms of technology, which is blockchain, but more in terms of applications that are powered by blockchain. So love to get your sense on why you're so excited about blockchain.
Yeah, I think that's really interesting, because the point you make about not talking about it as an application, as not talking about it as a product, but as an application is true. It's the same with AI, isn't it? It can be used anywhere.
Yes.
It's fundamentally a tool. And what's it put to you? How is it put to use? And I think initially blockchain, when it was new, it was being put to all these funky uses. And what came with the PR was not necessarily the most exciting use cases. And the two key use cases that I think are really exciting at the moment are sort of public international capital markets use cases and insurance. And insurance, obviously, we can talk about second, because it's a lot going on there. But in the legal tech world, one of the traditional kind of, I think, things that people in venture capital say is, legal tech is something that's been growing, but it hasn't exploded in the way that fintech has or health tech has. And so I think what's particularly interesting with blockchain in the legal sphere is that things like bond issuance at the moment are heavily manual. They require hours of human eyeballs and scrutiny. And you've got very large legal practices at the big players like Allen Overy or Clifford Chance, the big law firms, who are receiving very large fees, but also are doing a lot of work to effectively help somebody raise money on the bond markets. And a lot of that could be automated. And a business that I thought was particularly interesting in this area, and actually has raised quite a lot of money, albeit pre-Series A still, is a business called Navora. And Navora are effectively trying to use blockchain to simplify and speed up the bond issuance market. And they did a very large round full of strategic investors. It had London Stock Exchange invested, Santander Innoventures, Allen Overy, and a couple of other Magic Circle law firms. And so they really do have the right backing and cap table to enable them to have their products adopted quickly. And the thing that I find so fascinating about that is, at its core, you're just using distributed ledger software, blockchain, but you're replacing the entire underlying pipes for international capital markets, which is a massive, massive market. And if that sort of application for blockchain can be rolled out more widely, then the business that is doing that rolling out, whether that be Navora or someone else, stands to gain significantly. And there isn't really an equivalent business doing that in the current manual market. And so I think that area, from a sort of what is the size of the market, I think that's a real white space that somebody's going to have to take.
I guess the interesting component in, I guess, a capital markets situation is obviously it's going to be regulation driven, right? So how do all these different actors. It's interesting that they have, financial services player and a lawyer. I'm talking about the startup that you mentioned. I'd be curious to understand how like government regulators also get involved, right? Because I think we were all sitting here and agreeing that the technology that is out there is significantly better and the application of it is significantly better. But you do need like the counterparty to accept it, and you do need the governments to okay it, for this to go ahead. So there is this little bit of a network effect that needs to happen for it to start scaling.
Yeah, and actually that's going to initially slow the adoption of the technology, but it's going to create a very large moat around whoever is able to roll their product out first. And in particular, the UK, I find, is a particularly exciting place for the adoption of this sort of technology in the capital markets, because the FCA, whilst obviously being a regulatory body and being very difficult to deal with in many ways, are incredibly forward thinking when it comes to things like their sandbox or their accelerated regulatory approvals. And you see that with startups, particularly around the sort of pay advance industries, that they can get full regulatory approvals within 12 months for different particular areas. So you can see that the UK could be very well placed to be the sandbox environment for much of these new products. But you're right. I mean, that's probably one of the main reasons that this technology has taken some time to take hold. It's inevitable, I think, that it will be adopted because it is a magnitude sort of 10, 20 plus, probably even 100 times better than the incumbent solutions, the very manual processes. And so I see that as actually attractive as an investor, because I think the person that's going to crack that is going to have a real sort of blue ocean in front of them that they can sweep up before somebody else can get regulated.
So that's kind of capital markets. Interesting. You mentioned insurance. How do you see the insurance world kind of adopting this kind of technology?
In InsurTech, one of the key areas that I think is very interesting in the context of blockchain is the ability to automate some of the processes that either brokers are currently doing or brokers currently help with. So not replacing the broker necessarily, but augmenting the broker. The broker holds such a key role in the insurance market that fintechs that want to, or insurtechs that want to try and displace completely the broker, I think come up against a lot of resistance. And that resistance, because the market is the insurance market's incredibly relationship driven, much more so than many other markets. It can actually be something that halts adoption rather than just slows it.
Brokers give you distribution, which is the most important thing for an insurance business, I guess.
A fascinating business in this area is actually names. That's NAYMS, names. And they effectively are using blockchain and, in fact, even cryptocurrencies to enable the reinsurance market to become platform-based rather than basically assisted with brokers. And there are not many reinsurers. There are 3, 4, 5 in the world that are very large. And at the moment, many of the insurance products that are, for example, denominated in US dollar, will go out and will sell effectively to those 5 reinsurers a particular portion of the risk. And what's so interesting is that blockchain and alongside it cryptocurrencies, one of the things that crypto has done recently is not recently, but in the last couple of years, is introduce stablecoin and stablecoins, various stablecoins. And so whilst they benefit from the sort of infrastructure that blockchain has, they are fundamentally tied to whether it be USD or GBP or Euro. And what names are doing are allowing those stablecoin providers to provide coverage for US dollar denominated risk. Or at the moment, they've begun with Bitcoin products. At the moment, Bitcoin product insurance is denominated in USD, which is a terrible mismatch because obviously the volatility of the underlying insured products. And so their first product is to have a Bitcoin product insured with Bitcoin. But the logical next conclusion is you can take a USD product with the same platform that they have, and you can insure a USD product, reinsure a USD product with stablecoin, which obviously converts to USD one-to-one. So it enables you to use the quick distributed ledger system of stable coins around the world, not just one, but any. It widens the market of who can actually be a reinsurer, and it provides an application for cryptocurrency that fits within what I would consider to be a traditional financial market, a traditional insurance market. And so
really interesting.
I think that is we're talking the bleeding edge there. I think this is something that we'll hear more about over the next few years, over the next 2-3 years.
It makes a lot of sense. And I didn't really think about this. I guess on the insurance side, a lot of focus on distributed technology has been around kind of automating payouts, right? Because if you think about it, the insurer and the consumer have this kind of misaligned match, so to speak, because the insurer makes money when they reduce the amount of claims that they pay out, while that's not such a great experience for the customer, because that's why they're buying insurance. And so the idea was really, and you've actually seen some of this happen in the flights cancellation space, actually, because it might not be like a direct distributed ledger technology application, but the idea is basically kind of around smart contracts and having the ability to fact check across a central database that is governed, and then kind of initiating a payout, which makes a lot of sense.
Yeah, and in fact, that smart contract technology is exactly the sort of technology that is used to enable sort of widespread bond issuance automatically. Imagine if you could sign a standardized document and then immediately issue into the bond markets without having to go through multiple layers of either regulatory approval or human processing. Exactly as you say, it's fascinating. It's not necessarily what you think of when you think of blockchain, but it's fundamentally the same technology.
That makes a lot of sense. Interesting. Seb, the second one you mentioned was open banking. I know you guys have invested in Credit Kudos, so we're trying to build this alternative credit score based on open banking data. And then Vine, which is doing some really interesting things around kind of building payment methods on open banking. And then we've obviously seen a lot of money flow into this space, right? Whether it's from an M&A front with MasterCard, SoFi, Visa buying, Plaid, Galileo, and so on. And then also kind of from a funding standpoint, what is exciting you about this vertical right now?
Yeah, it's interesting because the sort of Plaid, but not just Plaid, but you got TrueLayer, you got Tink, all these other guys. I think that particular area, the provisioning of open banking APIs, is actually a really competitive space now. And as a seed investor, that's not where we'd be looking. I think that well and truly has some great leading names there, like those guys we just mentioned, but many others as well. What I think is so interesting about open banking is obviously there's two parts to open banking in the sort of European sense of the word. There's open banking, which is focused on, it's payment initiation service providers, PISPs, which is effectively, it allows a new company to come up and effectively act as an intermediary between a customer and the bank. And so the PISPs, that payment initiation side of open banking, we can talk about in a second. And the second side is access to data. And I think that's where most of the focus has been to date. So account information service providers, AISPs, in the open banking lingo. So access to data is an area which we find fascinating at TriplePoint, and it's one of the main reasons why we backed Credit Kudos. Because for a long time, the banks have not shared their transaction data or their account data, not necessarily just because they don't want to, although I do think that naturally, if you are a bank and you have a lot of proprietary data, you wouldn't necessarily want to share it. But I don't necessarily think that's the main reason they haven't shared it. I actually think the main reason they haven't shared it is because there's been legacy IT that's prevented that sort of data from being easily shared or integrated into other systems. And so what we're now seeing with open banking is we're seeing open banking catalyze investment, capital investment, and software investment at banks to the tune of hundreds of billions of pounds per bank a year. And it's allowing individual users to share their data with other providers that can then enhance the sort of products, fintech products, the financial products that they are offered in the future. So a brilliant example of this is with Credit Kudos. There is at the moment with the incumbent credit bureaus, sort of 20 to 30% of people are in the grey area, grey file. They're not bad credit, but they just don't have a lot of credit. And traditionally, we've all heard the story. Our mums and dads have told us when we were growing up, oh, make sure you get a credit card and you do some transactions on it, build a credit history, because when you come to get a mortgage, you don't want to be rejected for not having credit history. And actually, there are many people who might not be heavy users of credit who are credit worthy. And those people can really benefit from the businesses such as Credit Kudos being able to reference them through their transaction data to determine that they are creditworthy and allow them access to credit where they would otherwise have not been able to get it. Because obviously the incumbents, the Experians, Fiscals of the world, all work on historic data, and normally historic credit data, not just historic transaction data in the way that Credit Kudos codes, which is much richer form of data, which is currently being unused. So it allows democratization and access to credit potentially. And I think that's really interesting because credit's a fundamental thing that fuels the economy and fuels economic growth. And it doesn't always necessarily have to be bad. So I think the data side of it and what that means for consumers is fascinating. And then on the payment side, I mean, this is where it gets extremely exciting very quickly. It's not a sort of slow growth of the ecosystem. Payments right now are a very sexy area in venture capital. And why are they a very sexy area? Well, A, they are hugely profitable. I mean, Visa alone, is trading over 18 times forward revenues at the moment. But more interestingly than that, the area has so many different providers or services within it. So for example, in the payments chain, you start at sort of a bank, your bank. You have an issuer, you have a card network, you have an acquirer, you have a fraud checker, you have a clearing bank, you have independent sales organizations, which are ISOs who sell sort of terminals to SMEs. You've got this very large industry that's growing very fat of taking very small transaction fees consistently. And there is an opportunity in open banking on the payment side of open banking to simplify that down. And if you say, and I'm just taking numbers out of thin air here, the total fee on a transaction in payment from the acquirer back to the issuer with everything in between and the sales organizations on top is sort of 2% of a transaction. Imagine if you could say as an open banking organization, I'll facilitate your payment, but I'll do it for 1%. All of those businesses that have got large, and we've backed businesses like Payment Sense who are within that. But imagine if you could take just 1% of that 2% and how big that business could be. And that's one of the reasons why we back Vine.
No, I agree with you. I think the payment space is obviously the payment rails have been around for a while now. And I think the biggest challenge in this space is going to be really around conversions, right? So I think at the end of the day, let's call it the e-commerce vendors, they've spent so much time in the last kind of 5-10 years perfecting with their payment analysts, what the best payment flow needs to look like. And it's really kind of making sure that there's a clear kind of value connection between not only kind of reducing the fees you pay to the players in the value chain, but also kind of passing that on to the customer in some form. I think the credit players do a really good job in terms of packaging it up, right? So I would pay by Klarna if it was bypassing payment rails. I know it's not right now, but I would, because the value proposition of paying in 3 equal installments is so high, and then so I think kind of that needs to happen at a larger scale on the payment rail side of things with open banking in mind, because I think that's how you'll get kind of consumers to really adopt it. Because at the end of the day, it's you still need the consumer to initiate a payment, right? And that's going to be absolutely key.
Yeah, I think you're completely right. And in fact, in a wider trend that I guess you could call kind of access to payments, you have, on the one hand, you have this real move towards what's called IIF payments, instant, invisible, free, sort of quick, easy transactions. In that box, you've got Apple and Google Pay, you've got Klarna, Fast, Flux, all these guys you've heard of. You've now got Facebook Shops, you've got Visa Checkout has just changed to click to pay by Visa. It's all about just making the payment simple and straightforward, because as you say, it's about capturing the consumer at the point of payment, and they now have many options, and so the competition has grown, and therefore friction needs to reduce. What I find so fascinating about the open banking payment potential is that one of the things that credit cards have been doing for a while, Amex probably most famous for this, is the sort of level of cashback that is provided to customers who are using their payment rails, as you quite well put it. They obviously have such a large amount of cash flow that they're able to provide cashback without it impacting their bottom line materially. And just imagine if you had much of that payment system consolidated in one business, the size of the consumer benefit monetarily as cashback. Like imagine if Amex or whoever it may be controlled the entire payment rail system. Imagine the potential. Obviously, there's a little bit of trickle-down economics there, and I'm not sure whether trickle-down economics is always right, but the point is there's potential for a fascinating improvement for customers who are not necessarily credit users, but use obviously credit cards or your payment networks to benefit from a cashback perspective. And I think that's going to be one way that will incentivize new customers to use things like open banking, pay by bank. It's sort of a Vine technology.
Totally agree. Well, Seb, it was really interesting having you on the podcast and talking to all three things: blockchain, open banking, and of course getting to know TriplePoint a little bit better. Thank you again for being with us.
No, thanks very much for coming on. It's awesome to shoot the breeze. Yeah, it was lovely. Thank you.
Thanks for tuning into Rebank. If you liked today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.